Hello everyone, good Sunday. We're here to cover GTI today, and as usual we make a brief technical analysis first. And here we have the all history chart, which goes back to 1994 or 1995, when the company had its IPO here at about $25. It is at 13 now. So not 13, I believe it's 13.40 now, because this chart is not updated with Friday's session. Anyway, it doesn't matter. Okay, we have now the trend is becoming bullish again here above the 50 days and the 200 days moving average, as we can see on this chart. Nice bull run here over the past few days, and we have this resistance at $16, but the medium term trend, well, I can't say it's bullish, because it can be sideways here. That's the left part of the chart is higher than the right part, so still not bullish, but the short term is very bullish. Look here. Very strong volume above average, above the 50 days moving average, reacting well to this moving average and the 200 days. Well, the stock seems overbought now, but I really don't care much about overbought or oversold levels. As you know, I prefer to focus on the trend, and the trend is bullish. Now let's study fundamental analysis. Here we have the share count since 1997 until now. It was 44.9 million in 97, 99.3 million now. But we had here big jumps in the number of shares outstanding. Look here, from 45.2 million to 56.2 million, then to 93.4 million in 2003. But then since then it has remained more or less stable here, 91.1 million in 2004 and 99.3 million now. So considering a base year of 2004, the share count CAGR is 0.4%, just that. The market cap grew 12.9% since 2004, when it was 928 million, and now it is $1.33 billion. Okay, let's move on to the balance sheet study. This company has a lot of long-term debt. Look here, it was 722 million in 98 and 528 million now, so the long-term debt is declining, but still very high. And the current ratio improved a lot here in the first quarter of 2007 to 2.21. So the balance sheet is not very healthy, but better than what it has been in the past. Cash and marketable securities account for just 6.1% of total current assets. So this is a weak balance sheet, but the best we've ever seen on this company. As for revenues, look, they were trending down since 97, when they were $1.097 billion, and now to 2002, when they were 596 million. And now we had 855 million in 2006, and expected for 07 with the new guidance the company gave 966 million, which means a 13% revenue growth from 2006 levels, and I've considered also a 13% revenue growth for 2008. Revenue CAGR since 2002, when it hit this low of 596 million, is 10.1% for GTI, and the industry average grew 12.4%, so growing just a bit less than the industry. Gross margin is 34% for our company and 26.5% for the industry average. And the price to sales ratio, considering 2007 sales of 966 million, is 1.38 for GTI, and again 1.76 for the industry. So our company seems to be trading at a discount to its industry average here. Now let's check the earnings per share and net profit margin. Look here, our earnings have been very erratic, so very hard to predict what the future holds, because we have profits, then losses, then a bit profit, then losses, then and some huge losses here. So this is a dangerous stock, at least considering history. But if we consider the 2004 earnings per share number of 18 cents and the 74 cents expected for 07, earnings are growing 60% a year. But this is, we have to pick the dates very careful to get to this result. Net profit margin in 2006 was 5%, expected for 07 8%, and for 08 2. Price to earnings ratio, with the 2007 earnings per share of 74 cents, is 18.1 for GTI and 20.4 for the industry average. On my valuation model, well, I just have to estimate these four white lines, which are the dilution factor. I put here 2% because of that historical jumps in the share count, and but lately it has been very stable, so I guess 2% seems reasonable to me. Revenue CAGR 13%. This is the company's guidance for growth in 2007. I expect that kind of growth to continue. Initial net profit margin was 5% in 2006, and I estimate 8% for going forward. And this gives me an earnings per share estimate of 94 cents in 2009, with an earnings multiple of 20.4, which is the industry average. This tells me the stock will be at 19.10 in late 2009, and this means the share price compound annual growth rate will be 12.5%. So this is not attractive to me because I look for at least 16%, and 12.5 is good, but not good enough for the main portfolio. So I'll pass it on. But on a 1 to 10 scale, I give it a 6. Thanks. Bye.